Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today is Sunday, January 2nd, 2022, and this is Blockhead Traders Weekly. On this week's episode, I'm by myself, Sprocket888, and still a little bit off balance from the normal recording schedule and release schedule from the holidays, but we hope to get back on track soon. In this week's episode, we're going to take a look at a trade that I placed on New Year's Eve. But before we hop to that, I want to give a shout out to the Discord, link in the description below. You can hop in there, say hello. It's free to join. Tell us what you're trading. Tell us what you'd love to hear about. Love to talk to you and hear from you. Also, you'll find a description for thetagang.com/sprocket888. That is where I post each and every one of my trades, the good, the bad, and the ugly. In this week's episode, I want to take a look at a play that I put on New Year's Eve, last trading day of 2021 in the underlying of Peloton. And I did a naked put on Peloton, actually sold 2 contracts. And I want to talk you through some of my thought process leading up to the trade, where I hope the ideal outcome of the trade is, and like we always say, you need to have a plan no matter what happens. So then I'm going to take you through a couple of my contingency plans should the trade not actually pan out the way that I'm hoping it will. Moving to the trade on Peloton, what exactly was I thinking? So what you'll see here is I've got the 1-year chart of Peloton, and it has taken quite a beating. It had a high point of about $171, and it has been sinking ever since, with a recent low of around $33.91 a few days ago. And what am I after here in Peloton, you might ask? Because this chart does not look positive for things going up. And you have to remember, I am a premium seller. So I love to sell options when volatility is high. When volatility is high, premiums are high. So what drew me to this chart? Volatility, volatility, volatility. So you can see down here below is the implied volatility in Peloton. And there was a massive gap down a few weeks ago. And that ever since that point, you can see volatility has been on a continuous rise. And the saying goes, it's always darkest just before the dawn. Why on earth am I touching this thing? Like I said, volatility is rising, and with everything, there is always a reversion to the mean. And what we've got going on here is volatility is almost at an absolute all-time high for the past 52 weeks, which means we are super extended on volatility above the average over the past trading year. And so the biggest part of my play is just looking for volatility to contract. As that volatility contracts, the premiums will decline, and I'll be able to buy back my put that I have sold to cover and lock in my profits. As we look at this chart, the other thing that you kind of got to ask yourself is, okay, well, where are we really at? You know, is the slide still going to continue? Are we going to have more gap downs? And the truth is, we don't really know. You know, we had this giant gap down recently, but one of the key things that I believe I'm seeing here is really the price decline is starting to kind of level off. You know, we've fallen all the way from 171, and could we go lower? Absolutely, we could go lower. We could technically go to 0. There's really no crystal ball that's going to say whether or not this underlying is going to rebound from here, or if it's going to continue falling, or if it's going to trade sideways. And frankly, I don't care, because what I'm playing here is volatility contraction, and I'm playing the odds that I believe are in my favor. And what I mean by odds in my favor are, you know, we have this reversion to the mean that I talked about. We're almost at 100% IV rank for this particular underlying because the volatility has never been higher. Now, can volatility stay up here the whole time? Yeah, absolutely. There's no rule that says volatility, as soon as it peaks out, immediately turns and heads south, right? No, it can stay up here. It could even go higher and continually be setting new all-time highs of volatility. But we really have to look, you know, where has the stock been and what's the probability that that's going to continue to happen. I wanted to take a step back and look a little bit longer time frame. So here you can see what I put up is a 3-year chart. Now these are weekly candles, and what you'll notice is we're still, considerably well above the all-time low. I shouldn't say all-time low, the 3-year low of 1770 of Peloton. Again, 171 is the high in the past 3 years. And this 1770 actually came around March of 2020. And so where we're seeing Peloton approach right now is roughly the levels that Peloton was trading at before the coronavirus kind of engulfed the entire global economy. And if you remember, Peloton was one of those names where it was like, oh my gosh, everyone's staying at home. Prices are going to go up. Everybody's going to be buying Peloton. And there was a lot of extra value and growth that investors put on Peloton where they drove the price just to the stratosphere. And lately what we've been seeing is, people are starting to look back at this and they're starting to put Peloton trading it much closer to the book values that it sees. Is it still inflated? Absolutely, it's still inflated. But the point is, we are now approaching a level in the pre-pandemic range. Looking at the specifics of the trade, what we have here is on New Year's Eve, I sold 2 February monthly expirations at the $30 put for $2.15. That gave me a premium collection of $430 when I sold those 2 puts. Now, remember, selling those 2 puts obligates me. I am under the obligation to purchase those shares of Peloton stock at $30 if the person that bought that option chooses to exercise them. And so if that were to happen, I basically would need to pay $6,000 to purchase those 200 shares at $30. So that is where I come up with this non-leveraged buying power of $6,000. That is applying absolutely no leverage. This is also known as a cash secured put. I am putting up $6,000 in cash while this trade is open, so that if it is assigned, that cash is there to execute the trade and fulfill my obligation to the buyer of the option that I sold. Now, you might think, well, isn't that kind of risky? You might end up paying $6,000 for these shares. And that's where we look at the P&L chart below there. And what you see here is this is the profit and loss of Peloton given the price that I sold the puts at. And what you'll see here is this yellow line is my break even. And what this means is if I take into account the amount of premium that I collected, the $430, and I combine that with the price of the shares of Peloton, the Peloton shares could actually be as low as $27.83 before I start to lose money on that trade. Even then, we'll talk about some adjustments that I can make to the trade should I get assigned that'll keep my break-even point, actually drive it even lower than that. But as it stands today, that is where my break-even point is. And you might wonder, well, what's the odds that that's going to happen? And the thing with options is they're backed by statistical models. And what we have here in this light gray section is the 1 standard deviation range of the price of the option as it is projected to be on February 18th. And what they have here is this is directly related to the volatility. So the higher the volatility, the wider this range actually is. So as volatility falls, this range will become more narrow and narrow and narrow. And the current strike price is here at Peloton just below $36. And these percentages that are called out is the statistical probability that the underlying of Peloton will be above 27.83 is about 70% chance on February 18th to be above that price. There's about a 30% chance that it's going to be below that price. So as you can see, we have the probability on our side. Now, with a 70% chance of success, which I can tell you is statistically accurate as I have now placed hundreds and hundreds of these trades and found that in aggregate, these statistical percentages are super accurate. If anything, they're actually a little less accurate to the conservative side, which means the actual number of where it falls tends to be higher probability than it actually quotes you. But let's just, for argument's sake, say that they are accurate at 70% chance. So there's a 70% chance this trade is going to go in my favor. So that $430 against a $6,000 non-leveraged cost basis gives me a 7.2% return for under 40 days. Assuming that this trade actually doesn't need any adjustments or maintenance items put to it, in the ideal outcome, this trade will yield 7.2% in less than 40 days. Now, not everything works out in the most ideal case. So, as we always say on this channel, you gotta have a plan for your exit strategy. And that has to be a plan for when things go your way and a plan for things don't go your way. So what kind of plan do I have? What are my adjustment points? What are the mechanics that I'm going to deploy if this trade does not work out to my ideal favor? And really the first go-to, and this is really why I absolutely love selling naked puts, because that cost basis, that non-leveraged buying power, is basically fixed. That's not ever going to get higher than $6,000 because buying those shares at that strike price is always going to cost me $6,000. And what you can do is known as rolling out. So should this stock price continue to decline and decline and decline, putting me deep in the money, what I can do is actually roll that strike further out in time. So I can buy back the February expiration and I can then sell March. And that gives me an additional month for the price to move in my favor. And you really can do that indefinitely. So as long as you have that $6,000 to secure the trade, you can roll that indefinitely. What that allows you to do is, because you're pushing it out in time, you get the additional time to be right, but there's more premium because you're sending that price further out in time. So you're selling more time decay, you're selling more theta. So whenever you roll the trade, you'll always be rolling this for an additional credit, continually kind of drop by drop by drop, adding to the premium that you're collecting on the overall trade. So I typically do not begin to even consider rolling a trade until we get into the 14 to 21 days to expiration window. And why I do that is because, remember, you have to buy back the front month. So if I'm going to roll this, I have to buy back that February put that I sold. And I want to do that for as little price as I can. And you want to wait till you're closer and closer to expiration, because there will be less and less time premium in that when you purchase it back, which will give you a greater roll forward as you are buying back less time and then selling more time. My rule is to basically wait for the 14 to 21 days to expiration. And if it doesn't look like this trade is going to pan out, then I'm going to go ahead and roll that forward into the next month. And I will always do that for a credit. The worst case scenario, if you can call it this, is I could be assigned the options. Now, if you remember, one of the things I said is that when I sell a naked put, I must be okay with holding those shares. So I have to be okay with the outcome that somebody is going to exercise that option and assign me those 200 shares that I will have to purchase at $30 a piece. The reason I'm okay with that is because I do have an overall either horizontal or bullish sentiment on the underlying. And like I mentioned, in Peloton's case, yeah, could it go sideways from here forever? Absolutely. But if it's going sideways, I'm going to continue to collect premium. And what will happen is that if I get assigned, I will turn around and I will sell calls against those shares that I now have. I don't typically like to sell calls on naked positions because that is the one type of option that has truly unlimited risk to it, where you can really get underwater fast when you sell naked calls. But if I have the shares, it's no big deal. And I am going to look to sell a strike where, when I combine the strike price with the premium that I sell at, I will make sure that that is above my cost basis for the shares. when that's done above the cost basis, you're okay with being assigned and having those shares called away from you because you're going to turn a profit. So the key here is to always make sure all your adjustments net some sort of profit for you, so you're continually building your position up and up and up. Now, do I hope to use any of these? No, I don't hope to, but they're there. I have that strategy in my mind in case I need it. We'll watch this trade, and should I have to make any of these adjustments, I'll come out with a little video segment on this. We'll link them together as the adjustments made there. But ideally, I'm hoping to take this off the table in a few weeks. Remember, I take trades off at 50% profit. So on the previous target here of $430 in profit, I'm going to go ahead and step off this train around $215. So that will lower my percentage of return. However, the time frame should be dramatically shorter than 40 days. We'll have to see how that works out, but these are the mechanics for selling those Peloton short puts. Now, that brings us to the end of this week's episode. Hope you guys kind of enjoyed me stepping through real slowly a recent trade that I made on New Year's Eve with Peloton, selling a couple of naked puts on there, hoping to pull in about $430 profit, 7.2% return. Like I said, it's these little trades, understanding how the mechanics of each of these trade types work, that you'll just continually build in your mind, in your library, on how to execute these things. And the best way that I feel is to understand them is to either observe in detail someone else making those trades so you kind of understand the ins and the outs, or actually doing them yourself. If you have any questions, we'd love to see you in the Discord. Link in the description below. Feel free to hop in there. You can message myself or any other traders in there about trades that you're considering, questions that you might have on this episode. You can even hop in there and tell us what types of information you would like to see from us. Hope you guys had a great holiday season, a great start to your new year. 2020 should be a lot of fun trading in the markets. Remember, think outside the block.